As you may all know, closed-end funds typically borrow capital to enhance the yield of a closed-end fund. They can do that through borrowing vis-a-vis debt or issuing preferred securities. We won't get into the semantics of that, but they do have some SEC regulations around how much they can borrow. But the average closed-end fund typically borrows around 30 cents for every dollar of capital. So we'll use that as kind of a base case and a good example to illustrate on how we look at closed-end fund leverage and how it impacts our portfolios. So that said, it is important to note that we do look through the leverage of each closed-end fund, and we do take that into consideration. So that's the first step. So let's just say you have a closed-end fund, and it obviously has $1 of capital. And if it issues 30 cents of leverage, you now, if as an investor in that closed-end fund, for investing $1, you have $1.30 of exposure. So RiverNorth would look at this and say, we don't necessarily have to have $1.30 of exposure, so instead of investing $1, let's only invest 70 cents and still get $1 worth of exposure. And we do this at the fund level, or our fund level. So, for example, this is the RiverNorth fund. And again, it doesn't matter what RiverNorth fund we're talking about. The philosophy and the thought process is the same. And as you know, we're opportunistic investors in closed-end funds. So we never have 100% invested in closed-end funds. Because if we did, then we would ultimately, if this was 100% invested in closed-end funds and the average leverage was actually 30 cents, then we would, as an investor in the RiverNorth fund, somebody would have 130% of exposure, and we don't want to necessarily deliver 130% of exposure and have levered risk. So we try to back the leverage out. Let's just say 50% of the fund is invested in closed-end funds. If this 50% of closed-end funds have an average use of 30% leverage, our effective investment in asset classes is 65%. On a levered basis. So we take the 65% compared to the 50%. Obviously, it's a difference of 15%. That's the 30% leverage. So now we can have that 15% in cash. And we can use this cash for new investment opportunities when they may come about, or if they so happens we have redemptions, we can use that as well. But the important part is we have 15% in cash to be opportunistic still, to take on new opportunities. The remaining portion, so the 35%, is typically invested in ETFs or a sub-advisor, depending on what fund we're talking about. So here, from our standpoint, at the RiverNorth fund level, even though 50% of the portfolio is invested in closed-end funds, and it has an average leverage of 30%, we are fully invested, even though 15% of this fund is still in cash. Hopefully that makes sense. Please reach out to anybody at RiverNorth if you want further explanation. Thanks so much.